And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning. Welcome to the show. Of course, it is Tuesday, which means John Penn's joining me this morning, talking a little bit about two deads on money. We're going to be getting into a little bit about profit taking. I had a couple of good emails this week about taking profits, and we talk about that a lot. And you know, it's something kind of hard for individuals to get their heads around. A lot of times it's just like, well, if you say take profits, that means sell everything, right? No, that's not what that means. So we'll kind of get into that a little bit because we do talk about that a lot. You know, when we do our morning market wrap, we say, hey, look, you know, market's really overbought here, reduce some risk, take some profits. And again, that doesn't mean sell everything and go to cash, but that's just part of your risk management process. So we'll touch on that a little bit this morning. But kind of in the bigger news today, a big suite of earnings coming out today from big companies, Visa, others this morning, Broadridge. Tomorrow and Thursday will be Meta, Microsoft, Amazon, Apple, Google. So we're going to get 5 of the big 7 this week. So that will certainly be, you know, kind of moving the markets here over the next couple of days. And then also tomorrow will be the FOMC meeting where we will get the next conversation about, we'll potentially get a rate cut, which is highly expected right now. And then also conversation from Jerome Powell about what to expect next. That's also going to move markets in one direction or the other. If that's too hawkish, in other words, like, hey, we're going to do a rate cut here, but now we're going to wait and see type attitude, that could weigh on markets because markets have been pricing in more and more rate cuts here over the last couple of months. So again, lots of stuff coming this week. Certainly we are not without some volatility potentially this week. So just be careful of that. Outside of that, President Trump still traveling right now, cutting a deal with Japan supposedly, and we haven't got all the details yet, but working on a deal with Japan on rare earth metals to help reduce dependency on China in terms of the rare earth metals. And of course, we talked a little bit about yesterday. There is rumors that a deal has, you say rumors, but we've had conversation from Scott Besson himself that a trade deal is very much in the works with China. So hopefully that will get put to bed. And that's also what's kind of been moving the markets over the last couple of days, a bit of that relief kind of in the markets. So that's all that's going on right now globally. Again, there's not much to worry about. Seasonality-wise, we have now, just as of yesterday, started, actually I should say on really Friday was the day, but as of Friday, that starts the kind of seasonally strong period of the year. So, you know, as we move, October tends to be a little bit volatile. The last couple of days of October and then November, December tend to really be the start of the seasonally strong period. But what you need for that is a MACD buy signal to confirm you have entered into the seasonally strong period, and we actually got that 2 days ago. So again, everything's kind of moving directly in line with kind of where markets are. And now, when you take a look at a chart of the seasonal averages of the seasonally strong period, you see a little bit of a dip in October and then kind of a more sharp advance going into the end of the year, last couple of months. That's because of performance chasing by hedge fund managers, et cetera. If you take a look at the number of kind of the long-short positioning, they are underweight equities going into the end of the year. So they're going to have to leverage up and buy equities over the next couple of months to be positioned for year-end reporting. And the same thing goes for a lot of consolidated equity positioning across professional managers. They're underweight equities. So again, there's a lot of potential buying power here. And then you've got momentum literally just kind of in charge of the markets right now. So as markets move higher, and as markets move higher, that forces more money into markets, which drives prices higher, which drags more money into the market, so forth and so on. And then you throw on top of that 6 to 7 trillion a day, and 6 to 7 billion a day, trillion would be a lot, 6 to 7 billion a day in corporate buybacks, that additional buying pressure also lifting stock prices. So again, all that's starting to kick into place, and that brings us to what you need to know before the bell this morning, which is yesterday a couple of things happened very much on the bullish side. So, we talked about a couple of Fridays ago, we had this bit of the sell-off in the markets. That set the table by holding the 50-day moving average. that really kind of set the table here for this move higher. So over the last couple of days, what has happened is that we are now gaining momentum in that positioning. So again, after this pullback here that we saw, the market kind of struggled a little bit here, kind of consolidated below the 20-day moving average. When we broke out to new highs, it has now accelerated this move higher. So now we've got this fairly sharp advance moving up here. There's a running upper trend line, and we talked about this before. We had been in this trend channel kind of rising here for a while. The market stayed right within that trend channel. We broke out of that trend channel to the upside yesterday. And as I said, we've now triggered a buy signal, and we're moving relative strength back in overbought territory. So again, all this is telling you right now is there's really not much reason to be bearish on the markets near term. That's all that's saying. There's a lot of momentum in the markets. There's like that air conditioning commercial. You can't stop a train, right? So that's what's going on right now, is that you've got a lot of push here. At the same time, this is forcing liquidity into the markets. So liquidity has to come from somewhere. So other assets have to get sold off in order for liquidity to go into stock. So in other words, if I'm an asset manager and I've got money on my books and I've got assets over here and I've had some big runs in some stocks, big runs in other positions, and if I want to add more to this, I've got to get money from somewhere, so I have to sell something to buy something. And we're seeing that go on right now. We're seeing that exact rotation by looking at some other asset classes. Gold's having a big correction here. Money's coming out of gold to go back into equities. Again, that's not surprising. It's a beta chase right now. Gold was extremely overbought, needs to go through this correction. We're on a very good sell signal here on gold. We're working off that overbought condition. That's a good sign. So again, somewhere around 37.80. We took out 4,000 this morning. So around 37.80, you're going to find that kind of the 50-day moving average. Gold should find support around the 50-day moving average and then provide you potentially an opportunity to add gold to your portfolio if you're looking to do that. But I'd be careful of this sell signal right now. It's extremely elevated and needs to work off a bit. So we could be through a bit of a consolidation phase here in gold for a bit, as again, kind of as a liquidity source for buying equities. Bonds have also been performing very well this year so far. We've had a good return so far. Treasury bonds are up about 5% for the year as of yesterday. And then, of course, you throw the yield on top of that. They're giving you a compound return of about 9.5% this year so far. So again, bonds have had a very, very nice turn here as well. So money flows have been coming into bonds. It's been chasing stocks here for the last few days. Anyway, you just kind of, no matter where you look, the backdrop is really bullish for stocks, particularly with earnings, kind of in full force right now. And those earnings expectations should be good. That should give us about 2 months of run here into the end of the year. Anyway, that's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn, talk a little bit about how you take profits and manage risk in your portfolio. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
We don't hear anything. Gotcha. We hear nothing over here. We have nothing going on. All right, so welcome to the show this morning. All right, so John, good morning. How are you?
Morning. It's live, y'all.
Yeah.
Hey, good morning.
Yeah.
How are you?
Yeah, I listen for cues. For 20 years, I work off music cues. So if music's playing, I know the segment's starting. If there ain't nothing happening, ain't nothing going on. So anyway, it's hard to get good help these days. So a couple of things, like we said, we've had a couple of comments as of lately talking about how to take profits and those type of things. And again, that one of the big mistakes that investors make, and particularly younger investors, when they're managing a portfolio, is they tend to go to extremes in one direction or the other. They tend to overweight assets in their portfolio. Like something's working really well, so I just kind of go all in on that particular asset or that asset class or that theme of assets, whatever it is. And as long as it's working, it's great. But what happens is that we become overconfident in our abilities to, invest. And we believe that we're actually smarter than we are in terms of the markets. And the markets have a really nasty habit of sucking everybody into a particular asset class. And we get all these narratives about why an asset class is going up and why Beyond Meat's surging, right? It's going to come back from the dead. No, it's not, but that's what happens. And then, of course, you get the ultimate rug pull, and then prices reverse fairly sharply right after you buy it, right? So you tend to buy peaks, and you typically wind up selling sell-offs. And this is why we talk a lot about, don't do that. Managing money is not a all-in or all-out thing. Diversification is very important. And just learn to manage risk. And so we talk about this a lot. We'll talk about, hey, markets have had this huge run. Markets are getting very overbought again right now. But, at the moment, everything's fine. But at some point here over the next, few days, we get through earnings here this week, maybe next week, markets are going to get more extremely overbought potentially. And you're going to be set up here for a correction. So again, we'll start talking again about, hey, time to rebalance risk, look at your positions in your portfolio, kind of remove some capital. And that's where people tend to make a mistake. It's like, oh, well, Lance said take profits, so I'm gonna go sell everything. That's not what taking profits mean. That's an extreme move, which tends to that leads you to sell high and wind up, making kind of all the wrong decisions, and then you wind up chasing markets, trying to get back in, and just a lot of mistakes. In fact, that was a really good email I had earlier this week, is that a young gentleman emailed me, and he's like, hey, I've been out of the markets this year. I had some stuff going on earlier this year, so I got out of the market because I couldn't watch it. And I've been waiting for a 5% pullback to get back in. And it's like, well, what happened to the 20% pullback we had in April, right? Why didn't you get in there? Well, he didn't get in there, and then the market, because he thought the market was going to have a much bigger correction, and we're starting the big sell-off because of Liberation Day, and then markets come roaring back. And again, this is always the problem, is that once you're in cash, it's very difficult to get back into the markets. So again, kind of two things here about managing risk. One is it's not an all or none game. So it's not being all out or all in. That's market timing. That never works. Second thing is that once you're allocated, all you want to do is just navigate the portfolio and build a portfolio to weather market volatility. So in other words, you're going to have some defensive positioning, you're going to have some offensive positioning within your portfolio. And so no matter what goes on in the markets, you're going to have the ability to kind of weather that storm out when it occurs and navigate the bull markets when they're happening. And all you want to do is just steer the ship. So as you're kind of going, you're just nipping a little bit here, you're tucking a little bit there, you're adding a little bit over here, and adjusting the allocation to move along with the markets.
Yeah, that point around an all or nothing approach, I see that a lot. Mm-hmm. There are a number of folks that I visit with today who are not invested in the market. They want to be invested. They know they want their money to work and participate in the market so they can fight inflation, keep up with their purchasing power, and just have their money grow for them to support their future goals and objectives. But I find that a lot of folks are waiting for the absolute quote unquote perfect time to invest. They're looking for that, that big pullback where they can kind of go all in and really get everything at a great value. And that opportunity may not come. Or when it does come, when that opportunity does present itself, your emotions can kind of get the best of you, and it's like, okay, well, is this really the bottom? What if the market goes down lower from here? Am I really getting, entering here at the rock bottom price? There are a lot of folks that I visit with who, quote unquote, took profits back in 2008, but by taking profits, they sold out completely. and they've yet to get back in because they've been waiting for just the perfect time to invest. So I think there is something to be said that a lot of investors out there, they're waiting for just the perfect time to invest, and it's like an all or none. We make it very binary. It's either I'm all in or I'm all out. There's something to be said about just put some money to work, just get some money in the market, so that way if markets have some strength, you'll participate, but keep some cash back. And that way if the market has some weakness, well then you can nibble. And that's not timing. Nobody can time the market, but it doesn't need to be an all or none decision.
Well, that's really what it comes down to, talking about profit taking.
Right.
And like, for instance, we have a question in chat talking about, you always talk about taking profits. What would you recommend for someone who has a 100% C fund? So in 401k plans, there's different types of 401k plans. And some plans, like for instance, ExxonMobil, they don't have a Vanguard S&P 500 index per se. They don't have a Fidelity S&P 500 index per se. They don't have a Fidelity International fund per se, like you normally see in 401k plans. They have these funds like the C fund, the G fund, the F fund, and those actually are, in particularly a lot of cases, managed by Vanguard. As an example, the C fund is 100% S&P 500, which is technically a Vanguard index fund, but it's kind of their version of the S&P 500. So if you're 100%, so here's a good example of this. Markets are really, markets are fine right now, so you don't need to do a lot. If you're 100% C fund, you just kind of sit where you are right now. But there will become a time in the near future that you'll want to take some profits in that. And the great thing about a 401k plan is that it's all tax deferred, right? So I don't have to worry about tax issues by reducing or rebalancing my portfolio. So again, inside of your particular fund, you have the C fund, you have an I fund, an F fund, a G fund, which is the G fund is the government fund, and then the F is the kind of the cash version of that. So, so if you're 100% S&P 500, and we get to the point where I was saying, hey, look, there's a lot of risk here, take some profits. Well, depending on your risk tolerance, right? Maybe you just take 10% of your C fund and move it into the F fund or the G fund temporarily. Right? And then that way, then let the market correct, and then you can put that money back to work in the C fund at some point. So again, just kind of managing the risk in the portfolio. We're not talking about making dramatic changes. I wouldn't go 50%. I say, Lance said, take some profits here. I'm going 50% into the F fund or the G fund. I wouldn't do that. I would just trim it back a little bit, take some profits, and that gives you. See, what that gives you is it gives you opportunity. So the advantage of a 401k plan really is twofold. One, you're contributing to that on a regular basis. So every time you contribute, that's going right into your C fund. So you could, and there's another thing you could do is instead of contributing everything, to your C fund every month, contribute it to the F or the G fund and store your contributions as cash, so to speak, until you see an opportunity to buy the C fund or the S&P 500 at a cheaper price. And this goes with all 401k plans. So if you've got, and again, you can, whatever 401k plan you're in, you've got money market options in your 401k plan, you've got short duration bond funds in your 401k plans. So you could think about a couple of ways to manage your risk, which is one, contribute to something very conservative rather than dumping it directly into the market. And then when markets give you a pullback, say like April, you now have some cash to buy stuff at a cheaper price. And so the difference is rather than a dollar cost average, you kind of lump sum average over time. So you take bigger chunks of cash and put it to work at better prices. So again, but you wait for 3-5% corrections, put some money to work. You get a 3% correction, you put some money to work. You get a 2.5% correction like you had last Friday, you put a little bit of money to work. So again, you can use that opportunity to do that. Or you can dollar cost average into your S&P 500 fund or your allocation, however you want, and then just simply, when it comes time to take profits, shift a little bit of that into a lower duration bond fund or a money market option if you have that. So it's not difficult. It's just paying attention to what's going on with your money and how much risk you're taking.
Yeah. So even in your 401k plans, and I know there's a lot of folks that I visit with that have the thrift savings plan, and there's really a limited number of options of choices in there that you can choose from a mix of stock to bond, different type of funds. But as Lance was saying, you can, as when markets are strong, you can just step in and just peel back a little bit. Just peel back some of those equity mutual funds back. Don't get out altogether. Just raise a little bit of cash, maybe move that into a stable value fund, or like Lance mentioned, a short duration bond fund. So at that point, if markets do have a pullback at some point in the future, you just have some dry powder, for lack of better words, that you can use to get at a better value. And I think that's what I really try to help people realize is when you're putting money to work or deploying money into the market, are you going to get things at the rock bottom price? I hope you do. Chances are you probably won't. But the goal is to try to get an entry point where you're at a better value than where the market was previously. It might not be the rock bottom price, but for so long, so many folks that I visit with, they've been waiting for the rock bottom price, and they're waiting for the perfect time to invest, and they would have been much better off this whole time just letting their money work for them and putting their money to work, even if the market's not at the rock bottom price, or just trying to get money entered into the market at a better value than where the market was before. So it just doesn't need to be an all or none decision.
Yeah. Let's talk about small portfolios as well, because again, if you're a younger investor just getting really started out, you probably don't have a lot of capital invested in the markets, and so maybe you're buying, and I'll use a specific example. I got an email from a young gentleman. He says, hey, I'm just kind of really getting started out. He says, when I buy stocks, I'm buying like 6 shares of something. How do I take profits in a small account like that? So 2 things about managing a portfolio. I would not buy based on a specific number of shares. I know a lot of people, they go, I'm going to buy round lots of everything. I'm going to buy 100 shares or 10 shares, whatever it is. That gets you into trouble more often than not, because on 2 fronts. One, you're not buying, I'm buying 100 shares of this, but you're not buying enough to meaningfully move the index, to move your portfolio, right? You want your investments to have an impact. If you hit it right? And if I buy a stock right and it works, I want it to have a meaningful impact on my portfolio. So instead of thinking about shares, think about your portfolio in percentages. And you'll do a bit better over time by doing this. So in other words, say I'm going to have no more, because I'm going to risk manage my portfolio a bit, I'm going to own no more than 5% of any position in my portfolio. Okay. Why would I do that? Why wouldn't I own 20% of a position in my portfolio? Well, because if you have a 20% position in Beyond Meat and it falls 60% in a couple of days, it vastly impairs your portfolio. Right? If you have 20% of your portfolio goes to 0, which can't happen, that really impairs your performance outcome over time and impairs your ability. So you want to manage your risk size by limiting the sizing of your positions, your portfolio. We've talked about position sizing before, and actually I wrote an article on this about portfolio management on the website. So if you go to realinvestmentadvice.com and type in portfolio management, I wrote an article about position sizing specifically. But position sizing will save you more than not. It's not as fun as, going all in on something, but when that something goes wrong, it doesn't wipe you out entirely, which happens more often than you would like to acknowledge. So think about your positioning in terms of percentages. Okay, so let's say now in this case that you buy, let's use an example, and he's got a portfolio and he buys 5% of NVIDIA into the portfolio, and he buys 6 shares. That would be way more than 5% of a small portfolio, but you get my point. But he buys 6 shares of company ABC into his portfolio. That's 5% of his portfolio, right? So this is great. Now the stock does well. It grows to 6 or 7% of the portfolio. It's doing fantastic, and it gets really, really overbought. Well, now measuring in percentages becomes much easier than measuring in shares. Because what I want to do is reduce that 7% weight back to 5 in my portfolio. So I'm going to take profits, I'm going to reverse my position back to its target weight, and maybe I have to sell 2 shares to do that, or 1 share to do that. So that's how I know how many shares to sell, just by reducing my position size back to my original target weightings. And that's how we manage our portfolios on SimpleVisor in particular. So if you go to simplevisor.com, you can see all of our portfolios that we manage there, our thematic models, AI, crypto, infrastructure, all those models are there. Then plus our core equity models are there. And we manage all of those by we take a look at a position, as an example, say NVIDIA. So NVIDIA is 2.5% of our portfolio, 3% of our portfolio right now. So we look at NVIDIA in the S&P index. How much does NVIDIA make up of the S&P index? It's like 5-6%. Okay, well I take that, and if it's in our 60-40 allocation model, I take 60% of that weight, and that becomes my target weight for NVIDIA in my portfolio. So we try to, because we're trying to replicate benchmark performance while managing risk, I want to make sure that my positions are weighted relative to how they're weighted in the index. Because if I have a 2% weight of a stock that's 6% in the index, when the index goes up, my portfolio is not going to travel as much because I don't have as much weight in that one stock that is in the index that's pulling the whole index up. So a couple of ways to think about managing your portfolio. One, think about in percentages rather than shares. And two, think about weighting your shares relative to whatever your benchmark index is. So if you're buying small cap stocks, you can use a small cap index. If you're buying large cap stocks, you can use an S&P 500. But look at the weighting of that stock in the index and say, okay, how much weight should I have of that stock in my index? And so it's easy if you're 100% equities, but once you start allocating bonds into your portfolio and doing some type of adjustment, so 50-50, 60-40, 40-60, 70-30, whatever it is, you'll need to, whatever your equity percentage is in your portfolio needs to be the percentage reduction that you have of the S&P 500. So if you're 70% equities and you've got a stock that's 5% in the S&P, you would have 70% of 5%, right? So about 3.5%. So that would be what would be in your portfolio. But then again, the management becomes really easy because just as it gets overweight, you just reduce it back to target. Now, what do I do in that portfolio if markets are really starting to get ugly? Now I can underweight as well. So my target was 5, markets are getting ugly, something's changed in the environment, so now I can go to a 2.5% weight, right? Never go to 0 unless something's fundamentally wrong with the company. Something has changed environmentally, something's not working with the company, there's been a change in management, whatever it is, and you're going to sell the position and get out of it entirely and move to something else, then you can sell it entirely. But if you're holding the position longer term and you're investing in a position longer term, just overweight or underweight, don't go to 0. And you'll perform much better over time if you do that.
Yeah, so everything there, Lance, that you were just going through was around, in my mind, having a specific discipline or having rules when it comes to positioning your portfolio from an investment standpoint, how you manage risk. Mm-hmm. And through that whole process, having a process takes the emotion out of this, right? Because as people, as human beings, we're just wired to be very emotional when it comes to our money. And there's a little hint, and this isn't earth-shattering, but your stocks and bonds don't know that you own them, right? There should not be an emotional tie between you and the stocks and bonds, exchange-traded funds, mutual funds, whatever the investment vehicle is that you're using in your portfolio. You should really try your best to eliminate the emotion from that, because again, your investments don't know that you own them.
Yeah.
So what Lance was talking about there, if you think about your portfolio from how much weight are you giving one investment over the other, and what are your rules? Let's say for an individual stock, let's say it's a 5% position. That's your rule, that's your discipline. So you know if that position grows to 6, 7, who knows, 8, 9%, if it doubles, if you hit a home run, and that position is now a 10% piece in your portfolio, your rules tell you I got to trim that back down to 5. Right? Take the emotion out of it. Same thing if that position should pull back. Started off at 5%, maybe now it's at a 3 or 3.5. And it'll focus you to really look at that position, and you might say, did I just buy it wrong? Did I pay too much for it? Has something fundamentally changed with this business? In other words, does it make sense for me to still own this? Hey, is this an opportunity where maybe I can buy a little bit more and average back into that position, bring it up to 5%? So everything that Lance was talking about right there was about removing the emotion from your investment process, and that's where I see a lot of folks get into trouble.
Yeah, exactly. And you know, the issue is always about emotions, and that's what leads us to make our worst mistakes.
Yeah.
Good question, though, in chat, asking about, well, what about weighting ETFs like spiders, Qs, emerging markets, et cetera? Great question. It works exactly the same. So, for instance, we have what's called an accumulator model on SimpleVisor. So if you go to simplevisor.com, go to the portfolio section, we have an accumulator model under the portfolios and the thematic holdings, and that's weighted. So when you start weighting ETFs, you're looking for two things. One, you're trying to diversify between markets, because now we're talking about we're buying entire indexes, right? So I'm buying 500 S&P stocks, I'm buying 100 NASDAQ stocks, I'm buying international stocks, whatever it is. So now you've got really kind of two-pronged approach for your portfolio. One is, I need to build diversification across markets, and I need to create performance. So this is where it becomes a challenge. And this is where you need to set aside a lot of narratives that you hear on television and everything else. If I'm trying to create performance in a ETF built portfolio, first thing I need to do is select what my performance is supposed to be. So if you're a person that looks at the S&P every day and that's your benchmark, you need to build a portfolio that's going to keep up with the S&P 500. Because if you add a lot of assets that don't perform relative to the S&P 500 over time, you're going to be in trouble, because you're going to constantly underperform the S&P index, and that was your benchmark to start with. So you've got to set out a reasonable return structure that you're looking for. You got to have a target, right? It's like trying to build a house without a blueprint. I can go start slapping stuff together, pour a slab, I'll get a house, but it won't necessarily be a good house, right? I've got to have an architectural blueprint to follow. And so you need some type of target that says, okay, I'm going to build this, and my target is to get to here. And so once you can identify that, that can help you start selecting the assets. So for instance, in our accumulator model, that model is designed really for people just getting started out. It's got a $1,500 minimum just to get in and get you started, right? And the goal is you're contributing to this every single month, right? Every month you get some money, you're adding to this portfolio. And over time, it's going to grow with the market. So that particular model, I'm tracking to the S&P 500. So it's 30% S&P 500, 30% NASDAQ. So technically, it's about 60% large cap stocks. And having that much weight in those two indexes is going to give me very close. If nothing else works, I'm going to drag by 4 percentage points. If the market's up 10 and nothing else does anything in the portfolio, I'm going to have a 6% rate of return because I've got 60% weighted towards the index. The other holdings are emerging markets, small cap and mid cap, and a bit of real estate to kind of give it a little bit of buffer. And that's to lower volatility a bit within the portfolio. Well, and again, you're still all equity, right? There's no bonds in there, so you're not buffering a lot of volatility. But over the course of the last 15 years, small cap, mid cap, and emerging markets have grossly underperformed the S&P and the NASDAQ by a very, very large degree. So if you've had a lot of weight in those stocks, in particular, you've really lagged returns over the last 15 years. Now, just recently, emerging markets are performing a lot better, but they're still way behind large cap and NASDAQ stocks over the last 15 years. So there's no, and here's when you're talking about weighting an ETF portfolio, there's no holy grail, right? There's no magic mix that's going to get you there. A lot of this is just going to be how much exposure do you want to certain assets? And again, there's no wrong answer there. You can have no exposure to international, you can have no exposure to emerging markets, and it probably won't make much difference over time. But how you want to approach these things is and how you want to weight them is up to you. But again, once you get it weighted, now you go back to your portfolio management rules. So if I have 30% in S&P, if the S&P becomes 35% of the portfolio, it gets trimmed back to 30. If I see risk coming in the markets in that particular model, then I'll reduce that 30% equity exposure in the S&P index to 15 exposure. Same thing with the NASDAQ. right? So you can underweight. So once you get your target allocations, and again, you should be able to write down your allocation model on a piece of paper. If you can't do that, there's your first problem. You should be able to think through your allocation and go, this is how much money I want weighted here, this is how much money I want weighted here, this is how much I want in these asset classes here, and you have your ETF structure, right? So now you've built your model. You've got your model, you know which ones to buy, you know how much weight to buy with each one of them, and if you can't write that down on paper, that's your first mistake. So stop everything else you're doing, get that model down on a piece of paper. Every one of our portfolios has a model structure that we follow. But once you have that model structure with those percentages, now it becomes very simplistic just to overweight or underweight. You get overweight, you trim it back to target. If markets have a big bottom, and we haven't really talked about this yet either, but let's say we had that big sell-off back in that 20% decline back in April, right? And we see the trade deal coming through and we start to see some opportunity here. Markets, nothing says I can't take it from 30 to 35% weight in my portfolio either. I can overweight positions temporarily to take advantage of a pullback in the market. I can add capital to my positions and overweight them temporarily by adding new money. We're talking about lump sum averaging earlier. I can take money and overweight certain markets temporarily until they get back technically overbought, and then I'll reduce them back to their original target weights. So you can overweight and underweight to manage your risk profile within your portfolio, to take advantage of opportunity, and to reduce risk when that becomes necessary in the markets.
Yeah, so benchmark. So several times, Lance, I heard you say the word benchmark. What are you benchmarking yourself against as an investor, right? What is the purpose of your dollars? What are they for? That's the starting. That is where you start. And then from there, in other words, if I say benchmark, in my mind, that is, what is the rate of return that you need? Not the rate of return of your neighbor, not the return of cousin Freddie or Uncle Freddie that you're going to see at Thanksgiving. It's not their return. It's what is the rate of return that you need? What is your personal benchmark for you to hit all of your, for what your target return is, for you to hit your goals and expenses moving forward? My benchmark is different than Lance's. My benchmark is different than yours, vice versa, right? That really will lead you into, okay, what is the right way to structure the portfolio? And then you get into all those rules around managing weights and managing risk that Lance has been talking about. But sometimes I think folks, you make the S&P your benchmark. As investors, we've all been trained to make the Standard & Poor's 500 index our benchmark. You may not need that much return. Like, what is your hurdle rate? That blueprint that Lance was talking about when you're about to build a house. What is that blueprint? And for me, in that language, I call it, in my language is, I call that a financial plan. Where are you right now? Where do you want to go? Let's build that blueprint to look at how can we construct this to get you where you want to go 5 years, 10 years, 15 years, 20 years from now. What if you're about to retire in 3 to 5 years? How does your portfolio need to look to support the kind of the next chapters of your life? That's where it all starts, right? And through that blueprint or that financial plan, we'll figure out together, well, what is that rate of return that you need? What is that hurdle rate? And from there, how much risk do you really need to take? Hey, maybe your hurdle rate is, maybe you need to earn 5 or 6% a year. I don't know, I'm just making that up. Well, markets at what? What's the S&P up this year? About
15,
16%? Yeah. What if your hurdle rate is 6? Well, if you're not up 16% this year, but let's say your hurdle rate's 6, but you're up 14, we've more than doubled your hurdle rate. You haven't gotten all the upside of the market, but you're also taking a lot less risk to get that 14%, let's say, that you've achieved so far this year. So again, a lot of it comes down to what is that rate of return that you need? Start there, and then you can really start to build and put a portfolio together that supports your goals and objectives, and then you can get into all those rules around managing risk, managing position size, and taking profits that Lance's. That's how we tie it all together.
And I think that's really important because that ties into a question we had in chat. Was, if you're like 60 and you're near retirement, what kind of allocation model would you recommend? 60-40, 80-20, whatever it is. Well, couple of things. Again, this is why financial planning is so very, very important, because again, where most investors make their mistakes is they just start buying stuff in the market because it's going up. So they really have no idea how much risk they're taking because everything's going up. and then something happens that comes along and you get a big whack to your portfolio, and then all of a sudden you've really kind of messed yourself up for retirement. But without understanding what that hurdle rate needs to be, in other words, if I've got funding goals through retirement that I've got to meet, right? I've got to take care of healthcare costs. I've got living expenses. I've got to replace my income that I had from working. I've got to replace that in retirement. So how much do I need in terms of growth every year to get there? Well, for some people, they need like 2% because they've got enough assets saved up. They don't need a lot of growth, so they don't have to take a lot of risk. Other people haven't saved as efficiently, so they need higher rates of return to try to make up that shortfall. So again, that's where having a really good, sound foundation to start with. So again, we were talking about writing stuff down earlier. If you can't define what your goals are on paper, we talked about this a while back. We talked about having an investment policy statement. If you can't write down the rules of how you're going to manage your portfolio, if you can't write down what your goals are for your portfolio on paper, don't invest. You're not ready. Until when you can actualize what your goals are, then all of a sudden now things become very clear. I go, okay, I need these types of assets to get there. So, at 60, moving into retirement, you've got 20, 30 years ahead of you, hopefully, right? I mean, we're getting older, but we're not dead yet, and we're living longer. But again, risk becomes an issue. So this is where adding fixed income into your portfolio makes a lot of sense. However, we used to say 60-40 was a really good model for a person going into retirement because bond yields were around 5, 6, 7% back in early 2000. And so you could have, 7-8% return coming out of your bonds, and you had your stocks generating, 8-9% a year. It was pretty easy. The problem is today is that bond yields are at 4. I mean, we're slightly under 4. They'll be at 3 eventually because of inflation. Stock yields are doing great, but earnings yields as a function of that price adjustment are extremely low levels. Dividends on stocks are around 1.9% on the index. So now all of a sudden we're in a position to where investors that normally may have picked up a 60-40 allocation to manage their retirement income may need to shift that to 70-30. They may need more equity exposure. One of the biggest mistakes I see investors make going into retirement is being too conservative. And they'll go, I want like 80% bonds, 20% stocks. The problem with that is that in this environment in particular, bonds do not adjust for inflation over time. If I buy a portfolio of bonds, right, they're going to pay me an interest income every year. I'm going to buy a portfolio of bonds. They all pay 5%, easy math. Every year, I'm going to get 5% on that money. But the income doesn't adjust from those bonds for inflation over time. So if I buy 10-year bonds at 5%, over the next 10 years, I'm going to get 5% every single year. But that income is not going to adjust for inflation. So that's why I need stocks that will appreciate so that when I rebalance the portfolio, again, this goes back to, now we go back to risk management. When I rebalance the portfolio to, my stocks have now grown from 30% of my portfolio to 40, I trim it back to 30 and I go buy more bonds. Now that income is adjusting for inflation over time because I'm drawing my income from the bond side of the portfolio, which is also limiting my volatility, and I'm adjusting that income by adding money to it over time and increasing the income run. So the income adjusts for inflation because of what's happening on my equity side of the portfolio. So a couple of questions to answer your specific question. There's no set allocation just because you're 60, right? I'm 60. 100% stocks right now. So because that's where the market is and this is what I do for a living. So my portfolio's fully allocated. But there will be times that I'm going to drastically shift that allocation depending on what's going on in the markets. For you, your risk tolerance, your risk profile may be very different. You may be more conservative. You may need income now, but this is why sitting down with somebody like John that can actually build a financial plan for you and say this is what you need is a good starting point. But you can do it on your own. Right? I mean, you can sit down on paper and figure it out, but that's the first step is to sit down and figure out how much income you need. That comes from bonds. The inflation adjustment comes from stocks. Don't let greed override your logic in managing that allocation. So again, I apologize there's not an easy answer for you, but the reality is that if you're in your 60s, Probably an allocation, 60, 40, 70, 30 is probably a reasonable allocation. That will give you a good, strong inflation adjustment with lower volatility in your portfolio and capital preservation. Now, the bond side of your portfolio should be bonds, actual bonds, not ETFs, because you want the return of principal from those bonds in the future. So 30% corporates or treasuries. And if you're buying corporates, you buy good quality corporates, right? Apple's, Microsoft, those type of companies, ExxonMobil, those type of companies. Your spread differential right now between corporates and treasuries really doesn't make the sense to take corporate risk. So you might as well just buy treasuries at the moment. That'll change in time, but that's the way it is right now. So 30% should be in treasury, actual treasury bonds, 60 to 70%, depending on your allocation mix, that's in your good quality companies, right? That'll give you that, and we talked about this before. This gives you the three stools of your total return portfolio, which is you've got income from your bonds and capital preservation. You've got inflation adjusted growth from stocks. Stocks will adjust your portfolio for inflation over time. And then you have income from the dividends of the stocks. So you have two sources of income, dividends and interest, and capital appreciation to adjust for inflation. And then you manage that allocation by rebalancing to target on a regular basis. And I hope that answers your question.
Yeah, it's like a total return approach, right? Bond interest, dividends from stocks, capital appreciation potential from stocks. So it's a total return approach, right? And I would say, just kind of going back to the point that Lance made about, before you invest, write down what your goals are. Whether if it's a formal financial plan or if it's just some of the best rules I see are folks that just write this down on a piece of paper, then they type this up in Word, or a lot of folks I work with use Excel. It's okay. But it's all written down. And the goal is to keep your emotions in check, because look, we're all happy when markets are going up, right? Things are good. Like Lance said, hey, there's momentum behind the train, right? We're all happy. But when markets become volatile to the downside, and they will at some point, we just don't know when or what the catalyst will be. But if you have some rules written down where you have your mind around what those rules are for you, when markets get more volatile to the downside, you've already positioned your portfolio from a risk management standpoint where you can weather that volatility. And a market downturn, how will you behave in that moment? Are you going to put capital to work at an opportune time where things are a better value? Or are you going to throw up your hands and say, I'm out, I can't take it, and I sell out maybe at the worst possible time that could derail you from hitting your future goals and objectives? That's why it's so important to write this stuff down.
Yeah. No, I agree. Again, just going back, I cannot stress enough, everything that we do from the portfolio management side at our firm is written down. We have investment policy statements. We model these things out in spreadsheets and all kinds of other, tools that we have available. But again, before you do anything, write it down on paper. And if you can't get it down on paper, that's your first inkling that you need to stop and just kind of step back and rethink what you're doing. Because again, there's so much information overload right now from markets. People are saying, oh, buy this asset or buy that asset, buy gold, buy Bitcoin, buy stocks, buy bonds, whatever. Everybody's got an opinion, and everybody's got it right in their kind of their vision, right? But you got to make sure it's right for you. And so when you start putting this stuff down on paper, understand there's some things to think about. So I'm going to build an allocation for something, right? I'm going to build an allocation model. So go back over the last 15 years and look at the performance of every asset class you're considering for your portfolio. And what you're looking for is, you're not looking for performance. This is key. You're not looking for performance. And that's important. So for instance, like I said earlier, if you've owned emerging markets and international stocks over the last 15 years, you've vastly underperformed just owning large cap stocks. So why would you add the boat anchor to your portfolio? That's important, but that's not really what you're looking for. What you're looking for are assets that typically are not correlated to each other during a drawdown. So in other words, if you look at a chart of stocks and gold and international and emerging markets and Bitcoin, whatever, right? Just make your list of stocks, put them into a chart, look back over 15 years, and look at every dip in the markets, the ones that mattered. right? Like April, where you were down 20%, or 2022, where you were down 25%. How did that asset perform during that drawdown? Now, the reason this is important is if every asset that you own all goes down at the same time, that's okay, except for the fact you're not going to weather that drawdown. You're going to panic sell at some point. I don't care who you are, everybody has a point to where they will sell all their assets. It just depends on how much money they're losing. There's a point where you have loss avoidance and you'll get out of everything. So what you're looking for is saying, I want an asset class that in my portfolio that during drawdowns, it actually does better. And that will help buffer some of your portfolio. And that goes for stocks. So instead of just looking at an S&P index, look at sectors. Look for, or if you're buying an S&P index, look at a dividend aristocrat fund and see how it performed relative to the S&P during a drawdown. And then what you're looking for is to try to buffer that volatility in your portfolio so that instead of you going up and down with the market one for one, your portfolio goes down 20% of what the market does, and it goes up 80% of what the market does. And if you can limit that downside volatility, it's okay that you underperform on the upside, because over time you'll vastly outperform the index. And that's what you're looking for. You're looking for lower volatility to give you better returns over time, and more importantly, sustainability.
Yeah, so look, with all of your rules around managing risk in the portfolio and as nimble and as flexible as you might be, that doesn't mean that your portfolio won't come down in value during markets that are, let's say, volatile or pulling down to the downside, right? That's not saying that you're immune from a downward pull in your portfolio. To Lance's point, you want to buffer that. You don't want to be down anywhere near where the market might be, so that way you don't get derailed. And when markets start to recover, it doesn't take you 15 years to get back to break even again, right? So you're wanting just to look at how did that portfolio behave during times of market stress. Market stress is not a 2 or 3 or 4 or 5% pullback.
Yeah.
Right? I mean, we're talking about...
Although lately it's felt that way.
It feels that way, right?
You get a 2.7% decline, everybody. I'm getting emails like, oh my God, the market's crashing. We're down 2.7%. Yeah. Emotions are the things to navigate the most. All right, look, we've gone a little bit long this morning. We appreciate y'all being here. Be sure and get by the website, realinvestmentadvice.com. I've got a new ebook coming out. We're just building a landing page for you. It's a desktop trader's guide, which has all the investment rules, 181 of them for you, from all the great investors throughout history. So again, I've got that coming for you. We also have the Real Investment Guide. If you go to realinvestmentadvice.com and click on the Resources tab, go to Financial Survival Guides. I've also got the Real Investment Guide that's already been produced. That ebook is there for you as well. That goes through behavioral psychology, portfolio management, investing rules, how to use gardening to manage your portfolio better. Lots of good portfolio management stuff there as well to kind of give you a head start on, kind of thinking about how to manage your own money. But like and subscribe to the channel. We appreciate it very much. That certainly helps us a lot, keeps us doing this every day for you guys. And again, get by the website, realinvestmentadvice.com, and we'll see you back here tomorrow on Wednesday's edition of The Real Investment Show.